Hello, guys, and welcome to the Almus YouTube channel. This is our weekly windup series, and I'm your host, Swaraj. And today is a very, very special episode as I've got two very special people with me. Now, if you follow our market mornings, you will know them well. If not, let me introduce our money market pundit, Mr. Pankaj Rathi, and our forex guru, Mr. Jayaram Krishnamurthy. We will be taking you through the major developments of the week. This week, of course, was dominated by the RBI MPC decision. Now, one of the major highlights was the introduction of the standing deposit facility, which was set at 3.75%. So, Pankaj, my first question to you, what are the key takeaways of this MPC outcome? And could you also explain to our viewers the concept of SDF?
Thank you, Sauraj. Basically, let's cover first RBI Mpc statement and outcome of that, and then we will discuss about SDF also. So the primary shift from RBI Mpc is that they are shifting the focus from growth to inflation. Till last meeting, RBI was very, very clear that inflation is transitory, inflation is supply driven. But now RBI is saying that we have a priority to manage inflation over growth. And this comes back on a very high crude oil prices, which they have accounted around crude oil prices for $100 per barrel. The result or the impact of Russia-Ukraine is clearly being seen in the economy and RBI's shifting stance. RBI has changed in the stance in a way. They said that they maintain a accommodative policy, but now they will be targeting the withdrawing liquidity. So this is another thing. They have revised their inflation forecast and GDP both. Inflation forecast has been taken for FY23 at 5.7%. As previous policy, they mentioned it's around 4.5%. Wow, 1.2% shift in the CPI inflation. Now RBI has to change the money market trajectory or interest rate trajectory. And GDP, they have moved from 7.8% to 7.2%. Double whammy. So RBI has clearly taken now priority of maintaining, managing inflation. RBI has also a kind of taking handout of yields management. So they have not committed themselves for managing yields either through OMO purchases, GSEC assets acquisition program, and even then, or maybe Operation Twist. So these were the few developments. On the key monetary rates or RBI policy rates, RBI has taken out reverse repo rate from the liquidity adjustment framework. Now it will be the new rate which will be coming in picture is standing deposit facility. The name has been given and the rate has been set at 375. The similar framework, the similar rate was 335 of a reverse repo up to last policy or up to the last day. And this is a significant shift of a 40 basis point over a 335 to 375. Standing deposit facility is basically where RBI can absorb whatever excess liquidity banking system have, and they can give it to RBI for overnight thing at a 375. So this is new rate or new facility which had been introduced. Earlier, the reverse repo rate was doing the similar work, but that was a collateralized rate. Basically, whenever you give the money to the RBI, RBI was giving a security against it. Now, SDF will be uncollateralized. So 375, 4% and 4 quarter. These are the liquidity adjustment framework rates. 375 is where RBI will be paying money to absorb liquidity. 4% where RBI will be charging interest to people borrowing money from them or banks borrowing money from them, not people. And 4 quarter is basically a kind of a small penal rate if when the banks have not managed their liquidity according to LF and they're looking for extra funds from RBI. So this is what happened in the yesterday policy.
Okay, guys. So as Pankaj mentioned, the major theme of the MPC outcome was a shift from focusing on growth now to managing inflation, which is backed by the crisis and the Russia-Ukraine situation and the increasing crude oil prices. And I think we have got a pretty good idea about what an SDF is actually is all about. It's a uncollateralized method through which RBI absorbs liquidity. Now that we have discussed the actions of RBI, Pankaj, my next question to you, what is your sense of its implication on the spot rupee forwards and the OIS markets?
So basically, there's a clear hint of higher interest rates in coming time, and that market was anyway anticipating, market was pricing them. But this come as a kind of a very behind a very hawkish statements from RBI, suddenly shifting from 4.5 to 570. What happened is all interest rates have, or interest rates basically means OIS, forward rates, everything have gone higher. 1 year forward rate has moved higher by 20 basis yesterday. And if I talk about OIS, which is overnight index swap, which is an average of expected rates of overnight rates for a particular tenor, 1 year has gone higher by 35 basis point yesterday, and 5 year has gone higher by 27, 28 basis point. These kind of a move, again, I would say that it happens very rarely in interest rate markets, because interest rate markets are generally a very measured markets. So good amount of shift. And if you look at the chart on all those charts on all those tenor, it looks like we are heading towards some major adjustments. Another thing I just want to highlight that the forward premiums in Indian economy, or forward premiums in dollar rupee, was actually shrinking for last couple of months, where RBI said that we will be stay put on the Indian interest rates, and where the US interest rates were going higher. So these forward premiums were shrinking. Now, since RBI has also gone back and saying that they will be raising rates, these forward premiums are expected to expand further.
Do you expect deposit rates to go up, or lending rates to go up, or both?
Jayaram sir, thanks for this good question, because our clients and our customers would be basically interested to know this, will be interested. Let me put in this way, that RBI has actually put in another kind of instrument some 6-7 months back, and that was a VRR, basically a variable reverse repo rate. And they were basically doing auctions for those variable reverse repo rate, and they were anyway shifted the rates from 335 to 375, 380 anyways, and the market was pricing in that. So short-term rates were already came up, but this is a kind of a direction for slightly medium-term to long-term. And I anticipate that we will start seeing adjustments in repo rate. We will start seeing adjustments in fixed deposits. We will start seeing adjustments in lending rates. Now, it's also coming from a point where RBI has clearly mentioned during conference and some kind of a hint in document itself that they will be withdrawing liquidity also. Indian markets have enjoyed a closer to 7 to 8 trillion overnight liquidity, rupees 7 to 8 trillion rupees liquidity. And I have seen in my experience, liquidity provides more cushion to the rates rather than a lack of liquidity. So liquidity will be determining rates, and if the liquidity will be taken out, will be reduced, we will see impact on fixed deposit rates and lending rate as well.
So at last we are catching up with the global markets.
Yes, and I think this is maybe I'm coming on this kind of a platform first time, but this what we were anticipating for last 6 months to 1 year in across the market. Very soon we will see some kind of a reaction from Europe region. And if you see that way, the economies which have actually taken these prior steps to take rates higher, their currencies have done well. Just to quote Brazil, they have adjusted themselves for these higher interest rates earlier, and their currencies have fared well. So that's just an indication what we are discussing.
Thank you.
Wow, that was such a rich discussion, guys. And of course, the key takeaways are that there's a clear hint that we are moving towards an era of higher interest rates. Liquidity is also being withdrawn. Forward premiums in rupee, which was shrinking a couple of months back, provided that RBI was maintaining that it would keep the rates lower. Now that we are seeing a bit more hawkishness, the forward premiums have also started rising. A very wonderful discussion. And my last question is, of course, to you, JK. We are moving towards a crucial Fed meeting in May. What is your outlook for the dollar? Because we are seeing that the dollar index is already pushing against the 100 mark.
Yeah, thank you, Swaraj. Definitely, we are building up into the next meeting of Fed with lots of Fed members speaking and pitching for faster rate of interest rates, and some even going beyond 2% rate by the end of this year, looking at the way inflation is panning out, and particularly the wage inflation in the US. So the Fed's preference, or rather the bias to hiking rates faster, is strengthened by the fact that their economic data has been good. The last jobs report was very strong, and wage inflation was also higher. But compare this with other countries, you are having a tepid growth in other countries. Europe particularly is having a hard time because the war has its own impact. Then they have the energy problems. If there is a ban for imports from Russia, it will add to their issues. And already the economic sentiment is poor there because of high inflation. At the same time, what ECB is doing? Nothing. And they are just announced tapering of the bond purchases. There is no indication that they will be raising rates. There is no such message from them, but they are raising rates. Although market has started to discount a certain amount of rate hike in the Europe. So one currency is faring badly because the relative performance of US is superior and US rates are going up relative to theirs. And what about Japan, which is other major country? They're actually doing yield control, and QE is unlimited still. And they say unlimited amount of bonds will be bought to ensure that the yields are not rising beyond 0.25%. That is the 10-year tenor. And they are not seeing any inflation. So that's, you have a different world here. And when they are pitted up against the dollar, you are actually seeing, it's very easy to answer, dollar is going to be strong. Yeah, so 100 is just another number. We'll probably go beyond 100 in the dollar index. And this time I see emerging market currencies, which have so far held up well because they are all well prepared for this move by Fed by raising their rates and building forex reserves, etc. But now they may also move lower because Fed's indication of rates is even not topping out. So you may see a broad-based dollar move. Only thing that may come in the way of dollar moving far higher is the fact that beyond 125 or closer to 130, yen may become subject to some sort of intervention by Japan. So that's one thing that you may look for. And in Europe itself, while they are not raising rates, the higher inflation may actually lead them to resist much euro weakness from these levels. So we are entering into kind of inflection levels above 101 or near to 102. So that's where I see a cap for dollar index. But for now, definitely the trend is higher.
Okay, so that was very insightful, JK. And unfortunately, we are running short on time as well. I would like to thank both of you, Pankaj and JK, for taking the time out and also engaging in such a rich discussion. That's it.
Thank you, Sora. Thank you for all these good questions. We were able to express something to our clients.
Absolutely. That's it from our side. Everyone, do subscribe to our YouTube channel if you haven't done so already. I'll see you all next week. Do tune into our Market Morning series if you are interested in getting daily updates. That's it. Thank you all. Have a good weekend.
Thank you.